Investing is a crucial issue of constructing wealth and securing your financial future. However, it can be intimidating and overwhelming, especially for beginners. The right information is that there are some easy and tremendous techniques that can help you achieve your investment goals. In this video, we will disclose 10 investing secrets and techniques that can assist you maximize your returns and minimize your risks. Whether you are a professional investor or simply getting started, these tips can assist you make clever and knowledgeable funding decisions.
Welcome to GenUus.
1. Live below your means. Saving money is necessary for achieving financial success. It is difficult to have money to invest. Individuals can succeed financially and make investments in their future by leading frugal lives. Debt is like riding a rickety train rushing along the rails towards a broken bridge over the Grand Canyon. Purchasing anything besides groceries and rent in this condition is like sitting in the train ordering yourself a fourth cup of tea on credit. Happiness comes from overcoming challenges instead of indulging in luxury goods, but rather from pushing yourself and growing yourself. Financial success depends on living within your means. It includes spending less money and staying out of debt. Savings are feasible for both immediate and long-term objectives. 2. Regarding one's own financial situation. For one to achieve stability and financial goals, managing expenses is essential. Spending less allows people to save money for both short and long-term goals, such as debt repayment, home purchases, or a comfortable retirement. It's crucial to remember that cutting costs needn't imply compromising quality of life. It might be as easy as being cautious about making unnecessary purchases or looking for ways to reduce regular spending. Good cost management techniques can ultimately result in increased financial security and independence. 3. Buy the market. Diversify. Buying the market has two benefits. First off, it inherently offers holdings diversification, which lowers risk. Second, after deducting the fees paid to actively manage funds, investors can exceed the majority of other investors. Given how difficult it may be to choose a decent manager, investing in mutual funds run by experts may not be the best course of action. With each additional fund, the possibility of choosing lots of high mutual funds falls dramatically, although some investors may contend that buying the market only ensures ordinary returns. It is important to take fees into account because buying the market may outperform alternative investing options. Thus, it could be better to choose ordinary managers and triumph on price. 4. Don't look at past returns to gauge future performance. Many new investors tend to make the mistake of investing in actively managed funds and looking at past returns. This results in the classic error of buying high and selling low, as investors pour money into equities during good times and withdraw during crashes. Unfortunately, people tend to chase performance instead of buying low, leading to poor investment outcomes. As a result, investors may underperform the very funds they invest in, causing a reduction in returns. For instance, if a fund returns 8%, investors may only receive a 6% return due to buying and selling at the wrong time. It's crucial to avoid this buy high, sell low mistake and invest wisely to achieve long-term financial success. 5. Never try to time the market. Many investors try to predict the right time to enter and exit the market, but this approach is usually unsuccessful. If you want to sell your investment, you need to be correct twice because you must know when to get back in. Unfortunately, many people wait too long to get back in, missing out on the market's gains. Therefore, it's crucial to avoid timing the market and remain invested for the long run. Despite occasional small dips, the market typically experiences an upward trend over time. Thus, staying in the market is more important than trying to time it. Instead, investors should focus on the time they spend in the market, as it can lead to high returns in the long run. Therefore, the best approach is to buy the market and stay invested for the long haul. 6. Stick to your goals. It's essential to stick to your investment plan, especially during market volatility or when confronted with other tempting investment options. Deviating from your plan can lead to suboptimal returns and missed opportunities. By sticking to your plan and maintaining a long-term perspective, you increase your chances of achieving your financial goals. 7. Save as much as you can, as early as you can. If you start saving early, it can make a big difference in the long run. Let's say person A saves $5,000 every year from age 25 to 40 for a total of $75,000 and then doesn't save any more money. Meanwhile, person B starts saving $5,000 every year at age 40 and continues until age 65 for a total of $125,000 saved. Assuming a 5% growth rate, person A will end up with over $400,000 by retirement, while person B will only have around $256,000. That's because person A took advantage of the power of compounding by starting early, even though she saved less overall. So, start saving as early as you can and watch your money grow over time. 8. Look at the big picture. People often get caught up in the wrong details when it comes to investing. They might obsess over the performance of one investment instead of looking at the big picture of their entire portfolio. If you're someone who tends to do this, there's an easy solution. Consider a target date fund. These mutual funds are made up of a mix of stocks and bonds, and the allocation is based on when you plan to retire. Another mistake that people often make is focusing too much on yield. Many investors are drawn to dividend-paying stocks, but sometimes those dividends end up being taxed heavily and the stock price can fluctuate. For example, if you buy a stock for $100 and receive a $5 dividend, the stock price may drop to $95. So your total wealth stays the same, but if you invest $100 in a bond that pays $3 in interest, your total wealth will increase to $103. It's important to not just focus on income return like dividends and interest, but also consider capital return, the money you initially invested, for total return. 9. Automate good behaviors. To ensure you invest regularly and avoid missing out during stock market downturns, set up automatic investments with each paycheck. It can be challenging to find the time and motivation to invest on your own, so take advantage of automation. Additionally, regularly rebalancing your portfolio is essential to maintaining your desired asset allocation. If you started with 80% in stocks and 20% in bonds, but after a year, stocks now make up 85% of your portfolio, it's time to sell some equities and reinvest in bonds. Some companies offer automatic rebalancing, but you can also set up your own system. Consider rebalancing on your birthday or when you deviate 5 or 10 percentage points from your target allocation. 10. Minimize taxes. When investing, it is essential to reflect on consideration on the tax implications of your decisions. One way to limit taxes is to use tax-advantaged money owed such as 401(k)s and IRAs, which can provide full-size tax benefits. Additionally, you can think about tax-efficient investing techniques, such as conserving onto investments for extra than 12 months to take benefit of long-term capital beneficial properties rates, investing in tax-efficient funds, and keeping off commonplace buying and selling that can set off capital positive factors taxes. By minimizing taxes, you can hold greater of your funding salary and probably gain higher long-term returns. I really appreciate you taking the time to watch this video. Please leave your comments and let me know what you think. If you haven't already, kindly give this video a like and subscribe. I wish you a lovely night or day, and I'll see you in the next one.